Good morning and welcome to the Shenkman Private Client Group Accountant Attorney Winter Webinar Series. This program is entitled Charitable Remainder Trust, Planning Options for Clients with Existing CRTs. For those who don't know me, my name is Jonathan Shenkman, and I'm a financial advisor, portfolio manager, and an accredited investment fiduciary at Oppenheimer based in New York City. The goal of all my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 25 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in Barron's, CNBC, Forbes, Kiplinger, The Wall Street Journal, the CPA Journal, Trust and Estates Magazine, and many other periodicals. After the program, I'll send out a link to all the publications where I publish my work. Today, we're privileged to hear from Evan Unzelman, who is the president of Sterling Foundation Management based in Virginia. As president of Sterling, Evan's responsibilities include the supervision of all aspects of the company's business, including private foundations, supporting organizations, and public charities, and the firm's CRT secondary planning services. Evan is a sought-after speaker and writes frequently on charitable planning topics to a variety of audiences, including attorneys, CPAs, and financial advisors. He has particular expertise in all facets of CRT planning, upfront design and structure selection, implementing the chosen structure, reviewing existing CRTs for potential secondary planning, and helping clients and their advisors successfully navigate the sale and rollover processes. His articles have appeared in publications such as Estate Planning, Journal of Tax and Estate Planning, Taxation Exempts, Wealth Strategy Journal, and Atlantic Trust Advisor. He was the lead editor of the book Managing Foundations and Charitable Trusts, which is largely regarded as the definitive guide to managing charitable entities. Today, he'll be speaking on Charitable Remainder Trust, planning options for clients with existing CRTs. And with that introduction, I'll now turn the program over to Evan.
Okay, thank you, Jonathan, for the introduction and the opportunity to come on today and talk about options for clients with existing CRTs. Jonathan covered the high level on Sterling. Our CRT services, it's about a third of the firm's revenue at Sterling. So not the thrust of the business, but certainly a meaningful part of what we do. And we're happy to talk about it here today. As Jonathan mentioned, our primary business at Sterling is private foundation management and charitable advisory, really aimed at clients who are looking to take a very active role in their philanthropy and looking for outside advice on how to go about doing that effectively. Importantly, for all of the practitioners on today's call, we are not competitive. We do not manage assets or provide investment or tax, legal, investment, or insurance advice. So we're purely a partner for tax advisors, CPAs, legal advisors, trust and estate attorneys, and financial advisors, whether you're an investment advisor, broker dealer, et cetera. So we are non-competitive. Really, the idea behind Sterling is to provide the tax, legal, and financial advisor with an outsourced, turnkey, but non-competitive solution when it comes to your client's charitable giving. We've been around since 1998, and we got involved in the CRT space in the early 2000s. Started looking at it in 2001, and did our first sale transaction in 2003. And I'll hit on this throughout the presentation, but we really view ourselves and want to be viewed as a reviewer of CRTs, because that's really where all of this starts, is reviewing an existing CRT. But we do two types of transactions that we'll talk about. One is the sale of the income interest, another is the CRT rollover. But we're also involved in the appraisal and the Form 8283 required when a client just wants to gift their income interest to the charitable remainder man and collapse the trust, take a tax deduction, be done with it. So we're going to talk about all that here today. But really, reviewing CRTs is where everything starts. We've looked at 75 or more than 7,500 CRTs over the last 20 years for advisors and their clients. So we're going to talk about CRTs that are usually fairly deep into the life cycle of a CRT. So the CRTs are usually tied to an individual or a couple's lifetime or joint lifetimes. So they're around for a really long time. And most of the time where secondary planning is in order is deep into the life of the CRT, 10, 20, 30 years into the life of that CRT. But to get there, we need to really start at the beginning. And this is not a discussion about creating CRTs. We do get involved with the upfront design and implementation of CRTs. But when it comes to the secondary planning, it's important to keep the big picture in perspective. CRTs, what are they? I mean, these are tax planning vehicles that are put in place for really good reasons, usually tax. But they last a long time, and that's what I'll get to on the next slide, and that can lead to this misalignment deeper into the life cycle of the CRT. So CRTs, the decision to create a CRT is typically a tax-driven decision. Usually it's the primary motivation for creating the CRT is to defer the capital gains tax on the sale of appreciated property. So if I have $1 million in appreciated stock, I want to diversify that, sell that position. I don't want to pay the capital gains tax. There's a number of options that are available for me. Of course, there's the pure charitable route where I can give that stock to my private foundation, my donor advised fund, my alma mater, et cetera. I get a tax deduction based on the $1 million, and I completely avoid that capital gain. The CRT is sort of a hybrid between that option, the pure charitable route, and the traditional route, which is just sell the asset, pay the capital gains tax, and go reinvest the sale proceeds. The CRT is sort of a middle road. When I donate irrevocably the appreciated stock to the Charitable Remainder Trust, that can sell it. It's exempt. No tax is paid. But I am going to pay tax on the distributions I get from the CRT. And for all the accountants on the webinar, you know that I'm probably going to pay tax at a higher rate than my capital gains rate. Any ordinary income that trust earns has to be I pay tax on, distributed to me and pay tax on before the capital gain income. So most of the time, what I'm doing when I'm creating a CRT is deferring the capital gain into the future, and very likely I'm actually going to pay some tax on that future income at some combination of my ordinary and capital gain rate. But the goal up front when I create that CRT is defer the capital gain. We're not avoiding it like I would if I just gave it to charity. I'm deferring it into the future because I'm going to pay tax on the income that comes from my CRT. As I mentioned, most CRTs are lifetime income streams, usually for a husband and wife couple, joint lives. But it can be for a single life. It can be for more than 2 lives. And it can be for a term with a maximum of 20 years. But the end result of the CRT is the client owns the income stream from the CRT. Charity owns what's left in the trust, either at the end of that client's lifetime or joint lives with the spouse, or when that term is up. So the primary motivator, the primary driver behind the decision to create the CRT is to defer that capital gain. Of course, I retain that income stream. I get the income from the CRT for the rest of my life. I get an upfront charitable deduction. Now that's based on what the IRS projects on a present value basis will eventually go to charity. So because most CRTs are set up as lifetime trusts that will be around a long time, and it's a present value calculation, the charitable deduction I get is usually small in terms of a percentage of what goes into the trust. It has to be at least 10%, but usually it's pretty close to 10%, 10, 20%. Because most of the value of what's being contributed to the CRT on a present value basis is rooted in that future income stream, my income interest. There is a charitable component, of course. What's left in that trust goes to charity. But if charity, once in a while we hear, well, my client set up their CRT for charity. Yes, but that wasn't the main motivator. If the client's goal is charity, primarily, they're going to give that asset outright to charity. There's a charitable component to the CRT, but the primary motivator behind creating these trusts is that deferral of the capital gain on the contributed property. So good, strong tax planning vehicles here. But what we've discovered at Sterling is there's a flip side. And that flip side is rooted in this combination, this inherent combination with the CRT, where you have a trust with terms that are irrevocable. So when I create my CRT, the income beneficiaries, who the income beneficiaries are, is set in stone. The payout rate is set in stone. Most CRTs are going to pay 5 to 10, 5 to 15%, somewhere in that range. They can pay up to 50, has to be at least 5%, but most CRTs are going to pay between 5 and 10%. Sometimes when we see NIMCRUTs, we'll see them up to 10 to 15%. That payout rate is set in stone. The type of CRT is set in stone. So these are all CRTs, but they're different types of CRTs. Most CRTs are standard CRUTs. They just pay the fixed percentage regardless. But then we have NIMCRUTs, which will only pay the fixed percentage if it earns it. NICRUTs, where there's no makeup account, flip CRUTs, CRATs. We have all these different types of CRTs. The type of CRT is set in stone. So the key terms are set in stone, but it's going to be around a really long time. And unlike my estate planning, my investment planning, I can't adjust that as my life marches on. We compare it a lot to a house. We call it the house analogy. When I buy a house, I probably don't expect to live in that forever. Hopefully my kids will be gone in 20 years. I'm tired of mowing the lawn. I want to downsize. I want to move to a warmer weather state, a lower tax state. There's a lot of things in my life that will change and lead me to sell the house, but it doesn't mean it was a bad decision to build or buy the house. And it doesn't mean I didn't derive utility from the home when I lived in it. And that's really making the point here that these CRTs are put in place for really good reasons. Of the 7,500 we've reviewed, I could probably count on two hands the number of instances where we were just kind of like, why was this created? This was not the appropriate planning for the client. In the vast majority of situations, that was a perfect fit for the client when they created the CRT, but it's around such a long time that the client in 20 or 30 years is going to be in a much different position, both personally and from a financial and tax standpoint. That trust, such that trust that was such a perfect fit 20 years ago is no longer a fit. There's this natural misalignment that occurs, and the deeper into that life cycle of the CRT, the higher the probability that misalignment exists in our experience. So what we're going to talk about today is how to fix that misalignment, what the options are for these clients who have these existing CRTs. Before we talk about the options, I want to high level the tax and legal here, the tax and legal authorities. It's very simple. The ability to do anything, any of these, or to do anything that we're going to talk about today, to execute any of the secondary planning, is rooted in the way that the IRS views the income interest. The IRS views the income interest in a charitable remainder trust as a capital asset. And this is rooted in a 1972 revenue ruling that we've got up here on the screen. What that revenue ruling says is that an income interest in a trust, and any trust, is a capital asset that can be disposed of, and the proceeds are long-term capital gain property, taxable at the appropriate capital gain rate. So what that means is any client out there who has a CRT that's been in existence for more than a year, their interest in that trust is a capital asset that they can sell, and the sale proceeds would be long-term capital gain property. But like a capital asset, they have other options. They can give that capital asset to charity. They can use what we call a CRT rollover, and we'll go over this, and give that income interest into a new CRT, typically for their children or grandchildren. So we've got flexibility here because of the way that the IRS views that income interest, and that traces back to that 1972 revenue ruling. There were some PLRs in the 2000s on it. They're helpful in that they're looking squarely at CRTs. But all the PLRs are doing is referring back to the 1972 revenue ruling. So that's what gives the client the ability to do what we'll talk about here this morning. So what are the options? We call these options, but they're really alternatives. They're alternatives to doing what the client is already doing, taking income from the CRT. In our experience, if we're just reviewing an advisor's book of CRTs, in most cases, no action is necessary. We've looked at 7,500 CRTs. We've done 1,000 some odd transactions. So that gives you an idea of how many clients, once they're made aware of these options, are deciding that one of these options is of interest to them. The important thing is that the client is aware. Client awareness is what is, if you have, I would say, 5 CRTs, the chances are at least one, very likely more than one. I wouldn't be surprised if all of them had no idea that they can do any of what we'll talk about here. That's why I said earlier, and I won't soapbox here too much, but it's really, we view our role as a reviewer of the CRTs. We're not paid to review the CRT, but we believe that there's about 100,000 CRTs in the United States. If all these clients were aware of what they could do, we wouldn't have to market. At any point in time, there's going to be clients that are in a position where they would utilize one of these options, but they don't know that they exist. That's really the problem here. So what we really encourage is an upfront review. Now, it's not an investment portfolio. It's not real estate. It's not something that needs to be reviewed quarterly or even annually. In our experience, it's do an upfront review. And we'll talk about what's needed for a review later, but it can even be conceptual. You don't have to have Sterling run the numbers. It can be just conceptual. Hey, did you know that your income interest in your CRT is something that you can sell, or is something that you can use to create a new CRT for your children? It can be even conceptual. So traditionally, the sort of the most utilized option has been the sale. And the sale of the income interest is simple. If Jonathan is a potential buyer, and I'll talk about who the buyers are, but if Jonathan is a potential buyer, he's looking for the incomes from CRTs. He pays me a lump sum of cash for my income interest in my CRT, that capital asset. The CRT itself cannot be affected. So if I have a 8% NIMCRUT with $200,000 in the makeup account and it's tied to my wife in my lifetimes, that cannot change. What Jonathan is purchasing is the income interest in an 8% NIMCRUT with a $200,000 makeup account tied to my wife in my lifetime that will pay charity upon the last of us to pass away. Nothing with the trust changes. The only thing that's happened is Jonathan has brought from either his assets or an entity of his assets to escrow cash that he's paid to me in exchange for that future income stream. I receive cash. I'm cashed out of the trust. That's capital gain property. Jonathan receives the income stream from the trust moving forward. So the trust itself is not affected. That's important because if we'll talk about a termination of the CRT in a little bit. But if we terminate a CRT, what I get and what charity gets is bound by IRS valuations. We have to use the IRS valuations when we divide the trust between me and the charity. If I just go sell my income stream to a third party and that trust is not terminated, we're not bound by those IRS valuations. So the sale of the income interest is the first option. We're asked a lot, well, who would want to buy the income stream? Jonathan, he's buying an income stream that's tied to someone else's lifetime. He's taking on that mortality risk. What's in it for the buyer? With the pool of buyers that it is, everyone would imagine, this is a very, niche type transaction and it's a niche market. But what we've been able to do is develop a pool of currently about 75 buyers who are typically tax advantaged in some way. Now, these are not charities. So the first thing when I'm answering this question, who are the buyers, is answer who are not the buyers. Sterling is not a buyer. We simply broker the sale for a fee. And charities are not buyers. We'll talk about a termination. A termination is a deemed sale of the income interest to the charitable remainder men. A charity cannot buy the income interest then and that CRT keep going. We no longer have a non-charitable beneficiary. So the buyers are all taxable individuals or taxable entities. Now, the buyer pool that we work with and have developed over the years, it started in the early 2000s, and we were approached by the investment advisors for some business partners who have a large private foundation with us. And these business partners had a taxable entity with a large loss, a net operating loss in it. And this is like a 10 or $15 million NOL. And they were looking for income. For all the CPAs out there, you know that if you've got an entity with an NOL, you're looking for income, ordinary income, to use up that tax attribute. And what they thought might be true, and what is proven to be true, is that if we can match them up with a client who has a CRT, they knew that most clients who have CRTs are paying tax in that income. Even if a client is paying a low effective tax rate on their income, let's say they're paying 20% tax on every dollar they get from their CRT, they're keeping 80 cents. If we can match them up with a buyer who has some form of a tax attribute such that they could take that income and offset most or all of the tax, there's a spread that occurs. The buyer's keeping 100 cents on the dollar, the seller would keep 80 cents on a dollar. That gives us a 20-cent spread to broker the sale somewhere between. Similar conceptually to the muni bond market, where you've got a tax advantaged or a taxable entity on one end and a non-taxable entity on the other end. In this case, it's not a tax exempt entity, it's a taxable entity or taxable individual who has some form of tax attribute. So as we've developed this pool of buyers, that's really what we've looked for. Obviously, we're looking for high net worth individuals and families with good liquidity. If Jonathan buys my income interest, he's tying up a lump sum for quite, a relatively long period of time. They're typically charitable, but what really has driven the buyer pool that we've developed is some form of a tax attribute. And so that's over the last 20, this is our 20th year of arranging these sales. We did our first sale in 2003. We've done over 1,000 of these transactions. And it's a 2 to 4 week process, very simple private transaction between a buyer and a seller. It's an escrow style close that takes place at a large bank and under the supervision of an escrow agent. So that's the sale option. It's effectively cashing out of the CRT. And we'll talk about why clients do that here on the next slide. The next option is gifting the income interest. So if I gift the income interest, what's that fact pattern? This client wants out of the CRT, but they're not looking at it from their own pocket, from their own perspective. So this client will say, typically, the CRT is distributing taxable income to me that I don't need. I'm in many cases tired of dealing with the administration. I'd rather just give everything to the charity and be done with it. That's what we call gifting out, which is this will terminate the trust, but there's no need to go to court, notify the AG like I would if I just split the trust. So if and I'll talk about the steps in more detail, but if Children's Hospital is a the remainder beneficiary of my CRT, I will irrevocably contribute my income interest to Children's Hospital. They now own the trust. I receive a tax deduction equal to the IRS value of my income interest. We're not double dipping here. When I set up my CRT, my charitable deduction was equal to the IRS value of the charitable interest, of the remainder interest. If 10, 20, whatever years later, I give the non-charitable interest, my income interest, to charity, I receive a tax deduction equal to the IRS value. The third option is a CRT rollover. This is really what's popular now in this particular environment. The fact pattern here is a client who has a CRT that doesn't need the taxable income, but instead of just giving everything to charity, they're interested in using their income interest in the CRT to benefit their children. And this is called a CRT rollover. It involves creating a new CRT for their children and using the value of their income interest in the current CRT to fund and monetize that new CRT. But the fact pattern here again is, I don't need this income. I would rather use the value, the remaining value of my CRT to benefit my children. So those are the three options. On the sale, we're asked a lot about the buyers. We've talked about that. We're also asked a lot, well, what are the reasons that clients do this? I'll talk about those in a second, but just from a financial and tax standpoint, these are not typically drivers of the sale, but it's important to consider. You know, for the financial advisors out there, if we just run a present value calculation of the future income stream. So if we look at the client's life expectancy, how long do we think that trust will pay? We look at, we take a normal growth rate and we look at, okay, that's, you know, those are the future cash flows from the CRT, and we bring those to present value. We've got that pre-tax present value. Most likely the client can sell the income interest at or sometimes above that present value. That's not why clients do it. It's not, I'm not going to sell my income interest because I can net a little bit more on a present value basis, but it's important to understand that there's the discount for the time value of money, just the present valuing, but the client is not being forced to take a discount in exchange for that upfront liquidity. From a tax standpoint, again, unless we're in an environment where tax rates are known to be rising, this is not typically a driver. But if we just boil everything down to taxation, if the pre-tax present value of my income stream is $1 million, if I take that $1 million out from the trust over my remaining lifetime, that's going to be taxed either most likely at a combination of my ordinary and capital gains rates, or if the trust is invested in an annuity or fixed income, mainly fixed income, I may be paying mostly or all ordinary income on that CRT income. If I can sell it on a present value basis for $1 million, that's pure long-term capital gain. So the tax treatment of the sale proceeds, that $1 million, is in most cases going to be more preferential, better than the tax treatment of the CRT income I would take from the CRT over my remaining lifetime. Those aren't typically drivers of the sale, just like mortality risk. You know, if I look at it purely from a mortality standpoint, when I sell my income interest, I'm selling based on my life expectancy. I'm taking off the table the actuarial, the mortality risk that if I die before my life expectancy, I've received less than anticipated from the CRT. But why do clients actually do it? There's three main reasons. The first one is flexibility. So this, I just bring it down to, I would rather have a lump sum of cash than wait the rest of my life for the income stream. Why would the client rather have the lump sum of cash? I could stand here until tomorrow and talk about that, but a lot of time it's rarely, most clients with CRTs, I wouldn't characterize it as a need. Most of the time it's a desire. I'd rather, you know, give the money to my children. I'd rather, you know, invest in this real estate venture, et cetera. So a lot of different reasons, but that's really what I would bring it down to is it's the flexibility. It's having flexibility of that lump sum versus being limited to the income from the CRT. Simplification, particularly in the first part of the year when clients are dealing with the CRT tax return, that Form 5227. You know, a lot of clients just grow tired of that administrative burden, and they're just looking, you know, as they get older, to simplify their lives, their financial lives. And really a key reason for selling is to get rid of that administrative burden, which is shifted onto the buyer. And then family, I mentioned children and grandchildren earlier. I mean, this is, we'll talk about the rollover, which is really where children are in the forefront and heirs are in the forefront. But in a lot of cases with the rollover, we're creating the income stream for the kids. In some cases, we might want to do something now with that lump sum for the children, whether it's invest in their business or create the 529s or something like that. So family is very often at the forefront as well. The sale does not terminate the CRT. So there's before the sale option existed, the only other way to cash out from a CRT was to terminate it. Now, I won't get into the weeds here, but a termination is an actuarial split of the trust between the two beneficiaries, the income beneficiary and the remainder beneficiary. The trust is terminated. When we do that, the value of those interests is dictated by the IRS through what's called the 75/20 rate, their own discount rate, their mortality tables. And what we've learned at Sterling is that same income interest in a termination might be worth $1 million, but most of the time, if we go list it in the real world to a real world pool of buyers, it's going to be worth 15, 20, 25% more. So again, we'll compare it a lot to real estate. The government assesses my house. They value my house for the purposes of taxation, the assessed value. If I go sell that, list it and sell it in the real world, most of the time I can sell it for more than the assessed value. Very similar to what's happening here. If I terminate the CRT, we're bound by the assessed value. Whereas if we can go sell it to a third party and not terminate it, we're not bound by that assessed value, and typically we're going to be able to get more. Gifting the income interest, again, the fact pattern here is I don't need or want the income for my CRT, and I'm not interested, maybe I don't have kids, or I'm not interested in transferring additional wealth to my children. If I am, then I'm going to be looking at the rollover. If I'm not, gifting out is the way to go. Very simple, does terminate the trust, but because I'm not getting anything. If I terminate it and split the assets with the charity, now we have to notify the AG. The AG, the Attorney General, needs to make sure that charity is getting their fair share. If I'm just giving everything to charity, we don't need to do that. It's a simple 2-page irrevocable contribution agreement. I give my income interest irrevocably to the charity, the remainderman. They get the trust. I get a tax deduction. I am gifting a non-marketable asset. So it will require to form 8283 with my tax return, and I will need to get a qualified appraisal in connection with that form. That's something that Sterling can provide. If you have a client that's interested in this and you're looking for that appraisal, very simple to do if you have estate planning software. The CRT rollover, this is, as I mentioned, really what we're seeing the most of right now, because there's so many clients out there who have CRTs who don't need the income that's coming off the CRTs. And if they're made aware, if they're made aware of the option of, hey, instead of taking this income and paying tax on income that you don't need, you can use the value of that future income stream to create a new income stream for your children. We're finding that clients are jumping at that. And so with the rollover, it still involves the sale, but the sale value is dropping inside of a new CRT. So if I can sell my income interest for $1 million, that's the sale option. I sell my income interest for $1 million. That goes into my bank account. I pay the capital gains tax, but I get that $1 million. With the rollover option, I create a new CRT, irrevocably contribute my income interest to the new CRT, and that will sell it for $1 million. It's a taxable event to the new CRT, not to me. So, and I actually get a deduction, charitable deduction for the remainder interest in the new CRT. So there's more going on. There's more moving parts. So it's a deeper review with the rollover. But what we're finding is it's more relevant right now. So this is really what we're encouraging advisors to be on the lookout for. Don't worry about we can get through the nuts and bolts, the mechanics of the transaction. What we want advisors to be on the lookout for is the fact pattern. One, I have a CRT and I don't need, or in many cases want, that taxable income. Two, I have children. I like my children. I'm interested in doing more planning for my children. On paper, that's a great candidate for the CRT rollover. So to put a bow on it, we've talked about the alternatives to doing what the client is doing, taking the income from the CRT. There are three main alternatives, and they accomplish different objectives. The sale of the income interest will maximize the value for the client. The gifting the income interest to the remainderman, that's maximizing the value for charity. And then with the rollover, we're maximizing the value for our children. I don't have to pay any tax. I get a charitable deduction, but the driver behind that rollover is creating that future income stream for heirs, children, and or grandchildren. So I'll put my information up here on the screen. If you're interested in, if you have a CRT that you'd like reviewed, and I'll talk about a resource here if you just want more information in general in a second. But please get in touch with me or Dave Murray. Many of you probably know Dave. I'll have his contact information on the next slide. And we're happy to review the CRT. We do not charge to review the CRT. We are only paid if a sale is completed. Our fee is 3 to 6% of the sale price, depending on the size of the transaction. To review the CRT, though, it's completely complimentary. We do not need trust agreements, tax returns, anything like that. We just need the nearest ages of the beneficiaries, income beneficiaries, the payout rate of the trust, and the approximate trust value. With that information, in 2 to 4 business days, we will turn around and review and give you, the advisor, the information you need to share these options with your client. If you're interested just in generally more, just general information on this, the best resource we have is up here on the screen. It's our CRT Secondary Planning Resource Handbook. This is just one PDF or book that squashed a lot of the case studies, articles, legal and tax authorities, advisors' guides. We've squashed those all into one resource. It's called our CRT Secondary Planning Handbook. Shoot an email to Dave Murray up here on the screen, dmurray@sterlingfoundations.com. Dave is the Vice President Sterling in charge of our CRT service line, and he'll be happy to send you a copy of that. So with that, I'll turn it back to Jonathan. Thanks again for the opportunity to talk a little bit about existing options for clients with CRTs.
Great. Thank you so much, Evan. If anyone has any specific questions, new business opportunities, any other issues they'd like to discuss, please feel free to reach out directly to Evan or myself where appropriate. And I'll be sure to include his contact information in the follow-up email to this program. In case you missed it, the handouts of this program were sent out in the reminder email to this event. I will also send them out again tomorrow morning. As I mentioned at the onset, the goal of these programs is to stay up to date on timely wealth management related topics and to collaborate where appropriate. I think we can all agree that the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. 2 more quick items before I let you go. First, my next program will be on Thursday, February 3rd on spotting promoted tax shelters in real estate world, best practices and what to avoid, featuring Matthew Rappaport, Vice Managing Partner of Falcon Rappaport and Berkman based in Long Island, New York. Second, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees. And I thank you for that in advance. And with that, this concludes today's session. Please stay safe and healthy and have a wonderful day, everybody.